your chair set. I like your chair set.
Thanks.
For the third time, welcome to the 2020 NATE Internal Case Competition. I'll be timekeeping during the presentation. Now there's an audience member. Pierce, turn off your phone, please. Don't take photos or videos. Unless it's for Instagram, I guess. Be quiet about it. Audience members, please note, you may not leave the room or ask questions during the Q&A period. Presentation will be 10 minutes long. At 5 minutes, I'll hold up a green card, signaling 5 minutes left. At 7 minutes, I'll hold a yellow card, signaling 3 minutes left. And finally, at 1 minute left, I will hold a red card. At 10 minutes, I will bang on the desk and end the presentation. Following that, there'll be a 5-minute Q&A period, and I'll notify the judges when they're asking the last question. And you may begin whenever you are ready. I'll start the timer when you start talking.
Okay, so good morning, everyone. Thank you all for being here this morning. We are the Renaissance Men. We are a consulting group that have been hired by Spruce Land Properties Incorporated to analyze their situation and hopefully come forward with a solution. So what we're going to be talking about today is we're going to start with some of the company's goals, then we're going to go into our company's analysis and broadcast some possible solutions. Then we're going to give our recommendation for their current solution and the implementation followed by a conclusion.
So the goals for Spruce Land are to combat social and economic underdevelopment, attract further investment, as well as partnership opportunities and joint venture opportunities. Also, they want to maximize shareholder profit. The two biggest goals for Spruce Land, however, are shareholder profit and combating social and economic underdevelopment. The problem statement for Spruce Land is how are Spruce Land shareholders able to realize full market value for their shares? A quick stakeholder analysis, the two main groups I would like to highlight is the Slave Lake community and the potential investors. The Slave Lake community has high power because they hold a large number of shares of Spruce Land. Potential investors also hold a high power because they'll help fuel Spruce Land later on.
So briefly touching on the history of the shares here at Spruce Land. So they opened in 1970. It wasn't a public offering. They had opened at $1 Canadian here. And there was actually only 300 community-based shareholders that they targeted, issuing 65,000 shares. It took them 18 months to sell, just due to the nature of them not having this public offering and trying to target such a small market. In 1987, approximately 20 years later, they started to pay a common share dividend, so that's when you know the company's starting to turn a pretty substantial profit here. And then jumping to 2010 is when they actually had a stock split occur. So the stock split was a 3-to-1. Their new opening was now 33 cents Canadian. And as I'm sure a lot of you are aware, in about 2014 and around that time, the Alberta oil and gas economy was starting to really diminish. We were entering somewhat of a recession. This was not the case for Spruce Land. They were actually trading at an all-time high of $20 Canadian at that point in time after their 3-to-1 split. So their stock had skyrocketed. 2 years later, with the market getting even worse, their stock had just continued to rise. So they were having an opposite effect of the economy. And taking a look at the graph here, so our green value is the stock split. The stock split occurs just at the end of 2010 here, and as you can see, instantly in 2011, their stock skyrocketed. So this was a substantial strategic decision for Spruce Land. But this is the DRIP program. And so what the DRIP program is a dividend reinvestment program for their shareholders, these 300, to reinvest their dividends at a lower than market value for the shares.
So we have been offered 3 potential solutions by Spruce Land. The first one is to dissolve the company entirely. The second one is to use conservative position to take advantage of the market opportunity. And third, being restructuring the company entirely. So what we did is we created a decision matrix to analyze each potential solution, which we'll have Matthew explain for us.
Thank you very much, Jared. So what we looked at first was shareholder value, touching on our first slide there. We said that was one of the main pieces of importance of the company. And we felt that dissolving and taking advantage of the market opportunity would actually almost equally help realize the current $47 valuation. Because right now, the private sale of these shares for some of the people that are trying to liquidate, almost $20 to $25, like not even half of their market value. But looking at all the other pieces, if we dissolve the company, how can we be socially responsible? How can we align with our strategy anymore? And how can we attract further investment if there's no company to invest in? Shareholder value isn't the only thing that's important to Spruce Land. Social responsibility, combating the social and economic underdevelopment that Jack had previously stated, aligning with their strategy, and attracting further investment, are not only things that we value, but the actual board had put forward as the key factors going forward in past and present and future for the company, which is why we decided that it was a very obvious solution for us to take advantage of the current market opportunity based on their conservative positioning.
So our recommendation looks something like this. What we'll do first is pause the direct reinvestment program, which we expect will take approximately 1 month. Then we'll do another 3-to-1 stock split, which is very similar to what was already done in 2010. And we've projected that to take about 1 quarter or 3 months. Then we'll move into our property liquidity strategy, and using Lewin's change management model, we've projected that this will take approximately 3 quarters of the company's time. And then our final solution is a public offering on the TSX. This will obviously be the longest part of this solution, and we've projected anywhere between 1 and 3 years. We believe that this 4-point plan will cause our shareholders to realize their full market value.
The first step in our implementation is to pause the DRIP program. This was the only approved method of selling shares below market value. Pausing the DRIP program will allow shareholders to keep dividend income, and they can still choose to reinvest in Spruce Land if they would like to, and also allow shareholders to have a more diversified portfolio. The second step in the implementation is to do a 3-for-1 stock split. This lowers the price per share, allowing for greater liquidity and narrowing the bid-ask spread for stocks. Also, it renews investor interest and increases stock demand, as well as prospective investors are now attracted to the lower price. So in 2010, when Spruce Land did a 3-for-1 stock split, the stock in that year surged upwards 300%, and over the next few years, about 170%. With our projections from 2016 and onward, we believe that the stock, with a conservative estimate, will go up 150% yearly.
So now we get into the actual liquidity strategy that we are going to implement. The board of directors put forward liquidity and shareholder value as being the 2 main factors that are going to be of importance if we are to realize a full market value here. So we sought out a strategy that would substantially increase the liquidity of the company. The main thing I want to look at here first is the fair value investment property gain, or you could say capital gain essentially for the company. So in 2014 to 2015, this almost doubled. Their capital gains were significantly increasing. And we felt this was a significant value for them going forward in terms of their revenue model. So not a tenfold, I guess you could say, doubling year over year, but we did a conservative about 30% year over year capital gain growth. And the main piece on this slide is our cash flow. As you can see from 2014 to 2015, Spruce Land's cash flow increased almost $7 million, which at the time in the economy is very strange. But the reason for this was during the boom of the Alberta oil and gas economy, Spruce Land was preparing for the future. They were preparing for the bust. They were obtaining capital, obtaining cash flow, so that they were prepared for what Doug Victor, former CEO, now board member, has stated as a buyer's market. Interest rates are low. Capitalization rates are low. Doug Victor said it's time for action, and we agree with him. That's why we have this property liquidity strategy that they will have a certain percentage of properties being bought each year and a certain percentage of properties being sold each year. That'll help them wind up the value of their shares in the market to realize the full value. So in 2016, we're down from 17 million figure to 10 million figure, and that's because it's a buyer's market. We're going to take advantage of these capitalization rates. We're going to take advantage of being able to buy more property at the lowest value possible with their significant cash flow. They had prepared for this, so they need to utilize it. Let's say the market goes in 2018 to a seller's market now, though. Now they can do the same thing that they were doing when the economy was starting to get a little bit stronger again. Wind their cash flow back up and sell more properties that year. Let's say 15% sales, and then they buy 8%. So about a net 7 to 8% sale. But you're selling more properties when they're worth the most. So you are changing your revenue model to match the economy, to match the market. And not only does it diversify your revenue model, it gives you a lot of agility and a pretty volatile real estate market. And finally, a public offering on the TSX. So this is where it all kind of ties together, and the 4 main factors that we need to accomplish in order to be able to do this. Our size, which has already been accomplished, the amount of people that they needed to go public initially had already been accomplished, but they were never traded. They went public, but they had an exception with the government. It was a very special circumstance. Cost is almost negligible for them because of the sheer amount of cash flow that they have. This isn't going to be an issue. And liquidity, as we have previously stated in our first 3 points, has significantly increased. Now you've got increased credibility in the market. Now you're closing the door for any opportunity for shares to be sold at an undervalued level, And not only have we realized the full market value of that $47, but we are going to start growing that substantially higher. So we're realizing the full shareholder value and maximizing the full shareholder value all in one fell swoop.
So in conclusion, in order for Spruce Land shareholders to reach their full market value, I'd just like to summarize what we've talked about. We will pause the DRIP program and do a 3-for-1 stock split, as was mentioned by Jack, followed by a property liquidity strategy and publicly trading on the TSX, as was summarized by Mackie. So we strongly believe that if these measures are taken, we can make Spruce Land a profitable and successful company for many years to come. Thank you all very much for your time, and if you have any questions at this point, we'd be more than happy to answer them.
Okay, we'll start a 5-minute question period now.
So I've got a question around the stock split.
Absolutely. Are you referring to the initial 2010 stock
No,
split or the
the
one we're
second one.
proposing? I see.
So based on kind of assumptions from that first one, sounds like that's why you're making the decision for the second one. And seems like you're basing that decision on the results of that first one and assuming that that will happen again the second time. Which I assume, like, a lot of the market would have driven the results of that first one.
Absolutely, absolutely. And it's funny actually, because this is something that, as we were walking in, or I guess a minute or two before we were walking in, we had discussed this. 50% of what you referred to is exactly where we came up with the financials. The other 50% is that when they initially did their stock split and their shares went up tenfold, they hadn't tapped into the public market yet. All of their shares were being sold privately. Being able to significantly increase their liquidity and then being able to go public, we feel these are the most conservative the numbers could be, because the largest market that hasn't been tapped into yet is there. And the reason that we think that that market is going to be so profitable and valuable in terms of capital gain is people make emotional decisions and they justify them with logic. Let's say you're a company like TELUS. If I'm making an investment in them, it is purely a financial transaction for most people. A company like Spruce Land is a social enterprise. So people all over Canada would have a larger incentive to get involved if they felt that not only they were making a financial transaction, but they might actually have an impact in Slave Lake, or maybe in their community if Spruce Land was also able to grow and venture out socially into other provinces in the country as well.
I can dovetail on that then. Just you mentioned it as a social enterprise. So first you said 1 to 3 year periods to look at going public or implementing the public offering. Do you see any risk in terms of that community social enterprise, which is very much rooted in the community, with that move to go public?
Yeah, so what we actually initially had seen as risk it's actually the same thing that the board of directors had proposed. So their shareholders were always community-based. The company was based in Slave Lake. It started to grow a little bit into other parts of Alberta and Saskatchewan now, but the inauguration of the company was based on the foundation of the social and economic underdevelopment of this community. However, we did a very deep scan into not just the fact that these are the shareholders in the community, but who these people actually are, and the vast majority of them have been analyzed by us and by the board of directors to be people that are getting into the retirement planning stage of their life. They're getting into the point in their life where they're not looking to be a significant player in the market. They're not looking to really try and make a lot of financial transactions. They are essentially looking to have that full market realization of their shares, whether that be to cash out or to really, sustain themselves for the future. So we want to be able to satisfy those people, but still continue the growth of the company through other investors. And that's why we feel like the risk is being mitigated pretty well.
Just stepping back, you had 3 solutions around dissolving the company, position, take advantage, or infrastructure. You had said those were the 3 proposed by the board.
Absolutely.
Did you have any others that, as outside consultant, you said, well, there's option 4, 5, 6, 7 that should be analyzed, take through analysis?
We felt that the board had the best understanding of their company and what their goals were. We had taken a look at a lot of different alternatives outside of this. However, we didn't find a way that would holistically satisfy not only the shareholder value, but as well as the social responsibility and the strategic alignment of the company itself. We thought there might be ways to increase their profitability, lower their costs, mitigate their risk, as you had referred to, but this isn't what the board had hired us to do. The board wants us to help them realize the full market value of their shares. And so we felt that taking advantage of the market was what the best option would have been.
Absolutely, and just to add on to that, we did have some differing opinions certainly, but when we created this decision matrix with the 3 options that the board had given us, it became very clear early on that dissolving or restructuring would clearly not align with the company's goals, which made capitalizing on the market advantage the easy choice.
One more question, judges.
So, we obviously, as a company, made the decision not to go public
Yes.
years ago for strategic reasons. Why does this make sense now?
So initially, when the company decided not to go public, they were in a bit of a different market, a different economy, and their shareholders were all actually at a different point in time in their life as well. Similarly, what I was referring to when I was speaking to John, when I was speaking to Steve here, the shareholders are now at a different phase in their life in terms of finance. They're at a different phase in their life in terms of what their goals are. And so we feel that they aren't necessarily as invested in wanting to work 40 hours a week, be there, because mind you, most of these shareholders are either employees of the company or slave-like community members. So they don't want to spend their entire time with this company with the social and economic underdevelopment anymore. They are either looking to get the full market value for their shares to cash out, or to, like I had said before, keep sustaining themselves. So this way we can completely satisfy our current shareholders, which is the goal of the board and the goal of the company, but also continue to grow the company, also align their strategy, not just to what we think is successful in the future, but going back to their roots as well, because we felt that the company had started to stray away from some of the social responsibility and some of the combating social underdevelopment, I guess you could say. And so this will allow them to be able to satisfy that as well, which is part of the foundation of the company in 1970.
Okay, judges, thank you for the question.
Can I ask a judge's privilege on this
Very small. Because I know this is irregular. Just, you mentioned you were going to pause the drip program.
Yes, correct.
Now, is that temporary, or is that long-term? Just was looking for a quick answer on that.
It would be temporary until later on we'd get more investors, and as the company would be beginning to grow and the price per share would be higher, we could re-implement this drip program.
Okay, perfect, thank you.
Yeah, the main reason for pausing the program is to eliminate all channels of there being a possibility to sell the shares at below market value. If there's no longer private sale and the DRIP program no longer exists, publicly trading the shares will help them realize that for them.
Thanks.
Thanks for the questions, judges. Steve, you could exit the room. I'll call you back in just a few minutes.
Thank you.
Thank you.